analyzing companies and what does it all mean, subscribe to our channel, where we're going to be doing a lot more content on that. So Zaven and I both are going to be going into deep dives in some of these things ourselves individually. But as usual, we have a discussion today on a new company that's been put onto our website. So we've got our sort of co-host, co-founder of the Money Cog, Zaven. Yeah, how are you today?
Hi, yeah, I'm doing all right. Thanks for having me again.
No, great to have you. So we're looking at today a US company, if I'm right.
Yeah.
And the way to pronounce it is Penumbra, isn't it? Or is that wrong?
Penumbra.
Penumbra. There you go. Penumbra. So Penumbra is what exactly? What business is it? You know, how does it make money as well? So give us a bit of a synopsis of what the business does.
Okay. Penumbra is a medical devices company. It's manufacturing specific pieces of equipment that are used by surgeons for treating vascular problems. This is basically anything to do with blood flow. This could be issues such as a clot, a stroke, aneurysms, this sort of stuff where it requires immediate medical attention, and you need special devices to be able to sort those issues out. So, for example, if someone goes into hospital because they're having a stroke, they need to go in and perform something called a thrombectomy, which is essentially where you get rid of the blood clot, and you need special devices to essentially hold different veins and arteries open, and that's what Penumbra essentially manufactures. That's what it's built its portfolio around.
So you've become quite a bit of an expert, because you've looked at quite a lot of medical companies, haven't you, in the past? You know all the technical jargon. It's an interesting area, actually, isn't it? And in your notes specifically, you mentioned things around sort of the immersive healthcare segment. And obviously, for those probably like myself as well who haven't looked at that many medical companies, what is that? And why don't you give us a bit more in terms of that revenue spend? And you mentioned a few things there in terms of blood, in terms of the different portfolio products they have. So how does it all split in terms of different revenue segments, or is it even split?
Okay, so in terms of immersive healthcare, this is a relatively new area. The industry itself is still in its infancy. We're sort of seeing where it goes. We don't know exactly how large it's going to be, although there's quite some bullish analysts out there. And this is something Penumbra started investing in back in 2020. And just earlier this year, I think it was back in March, they released their first immersive healthcare product, which is called Real Immersive Sim. And basically, it's introducing virtual reality into healthcare. In this particular instance, they're going to try and use it to help treat patients with psychological problems. So if someone's suffering from PTSD, for example. But today, it's because the system is so new and they haven't commercialized anything beforehand, it hasn't contributed to revenue thus far. It launched in March, so in the first quarter results, it hadn't contributed any revenue. It may be contributing revenue in the second quarter results, and I think that's coming out in a week's time or so. So I'll be looking to see how things are going on there. But to date, based off the data we currently have, the revenue is generated from its vascular products, stuff to do with the blood flow. So there's quite different spaces, and we'll get to a bit into more detail about it later on. But in terms of its vascular products, there's two. You've got cardiovascular, which is all the blood circulating around your body. And then you have neurovascular, which is basically the same thing, but it's all happening in your brain. And Penumbra tackles both sides of the market. About 55% of the revenue stream comes from cardiovascular, with the rest coming with blood flow circulation products within the brainstem, which is a bit more tricky to operate, and you need some specialized surgeons to get into that area, because otherwise you could do some serious damage.
No, makes sense. Yeah. And you sort of mentioned and touched upon on it just now in terms of it kind of makes sense that their customers wouldn't be the end individual, right? Because it's clearly hospitals, etc. But maybe you can go into a bit more, how do they actually reach that customer? What's the process? What's the sales sort of cycle that they do? Is it coming, do they use third parties to go there, or what's that process?
So normally when it comes to medical device companies, they usually sell their products through group purchasing organizations, which are essentially a giant collection of stuff that allows hospitals to buy in bulk, sort of thing. Penumbra doesn't seem to take this approach. Instead, it actually contacts the medical professionals directly, the ones in charge of sorting out hospital budgets and all that lot. They actually have sway in running the medical facilities, and they're upselling their products basically directly to them, because these are the people going to be using them. They want to make sure they're the ones, they're fully aware of the advantages versus competitors and stuff. And about 83% of sales actually comes through this direct approach, which is quite impressive. The rest of it comes through distributors, as well as royalties received from licensing agreements to other third parties. But the bulk of it is through direct sales.
Okay. I mean, that's fairly strong contribution to sales channel. So hopefully that still, I would assume it's still a very strong, they've got strong relationships with these sort of purchasing groups that you were mentioning, and it seems to be doing sort of quite well. But I guess, is that in the US or is that revenue global? What does it look like globally?
Penumbra was founded in America, so unsurprisingly, around 70% of its income comes from America still. And the US being the largest medical market in the world, that makes perfect sense. But around 30% does come from internationally, which it's nice having that global reach. It's certainly a larger market available in places like Europe, for example. But as a consequence, the bottom line does have to suffer the fluctuations of foreign exchange rates, which you can mitigate it, but it can sometimes cause a lot of hassle.
So you just mentioned something about bottom line. So we were talking a bit about revenue. Let's go into the cost structures. Let's see what the cost structures of this business looks like. So what's the cost mix like, and research development and the different cost buckets that we normally talk about? What does it look like for a business like this one?
Being a medical devices company, as opposed to offering services, it's offering products. So it needs to actually be able to manufacture these things. A lot of companies like to hand that off to third parties. Penumbra doesn't. It does all its manufacturing in-house. They have their facilities based in California. And that has its advantages, in the sense, if you're a medical company, you want to have complete control of the manufacturing process of your products. These things need to work, and if there's any defects, it can cause problems. But on the other hand, it means the company has to deal with managing and maintaining its own supply chains, which unsurprisingly have suffered recently.
Yeah.
If anyone's noticed, there's a pandemic still ongoing. I mean, it's not as bad as it used to be, but it's causing a lot of issues. And looking at the most recent results, it has actually put a damper on profit margins. Gross profit margins, I think, are currently around 62.5%, which is still pretty good. But versus pre-pandemic levels, it's down from around 68%. So there is some sort of pressure coming as a result of that. Long term, I imagine they'll be able to sort it out, something to keep an eye on. Well, we'll see. Overall, it's not the end of the world, but it is worth, just to keep track of how things are going there. The other large expense beyond the marketing teams and all that lot is, again, like you mentioned, research and development. As with any company whose lifeblood depends on innovation, this is pretty important. If the firm is unable to maintain or keep up with their competitors in terms of technological innovation and progress, they're not going to be able to retain their market share. So seeing management consistently contribute towards research and development is encouraging, especially during times when profitability isn't all that great versus relative to what it was in the past.
Okay, so talk about profitability, we talked a bit of the past. Maybe a quick question before we go into a bit more of the company, so people get a feel for this company in terms of stock performance, because obviously this is a public company, and we talked about companies which are public companies because we're talking about investment opportunities specifically for stocks in public companies for our not clients, but for all of our users of the premium platform on the Money Cog, which people can join and see. We've got probably quite a big database now of companies both in the US and the UK that we look at and we cover. What about the stock performance? So we don't tend to look at past indicators. We're not, the Money Cog isn't a platform where we like to look at a lot of data points, because we find that everybody's got their data points. We're more qualitative by nature, but quantitative metrics are important, and we could talk about that a bit in the fundamentals bit. But what's the stock been like for the last 5 years? How's it performed?
So share prices, like you said, they don't really tell you much about what's going to happen in the future, but they're always fun to look at. Over the last 5 years, the stock has actually gone up by around 75%, which is around about 11% annualized return. Very respectable. However, it's worth noting that because we've had the stock market correction over the past couple of months with everything going on like that, this has actually reduced. They've lost a lot in the recent months, in fact. So if we ignore what's happened in 2022, just look at between 2017 and 2021, the stock was actually up 257%, which is
Wow.
significantly higher. We'll go into the valuation a bit more into why that's come down so much. But overall, even with the correction that we've had these past few months, this share price is still performing admirably.
Okay, and normally you always allude to who's running the business and management and the CEO, because that gives you an indication of strategic decision making and where the business is to go. And I think it's becoming ever more important, especially in the metrics that we look at, is who runs the business and what they're doing and assessing their decision making process. Because in the world we live in today, ever moving and fast paced, you need CEOs who can adapt and manage in very difficult circumstances. And sometimes in the benefit of having, as we know, free cash flow, that can be to your advantage. You can do good M&A and you can do good acquisitions or redeploy that into good projects in-house that you can spend money on. But for those who don't have the luxury of that, it's how do they manage their cash flow and the strategic decisions that management makes. So who runs this business? Is it actually run by the founders, or is it a new management team?
Yeah, so until recently, it was co-run and co-founded by Adam Elsisser. I can't pronounce his name very well, and a chap called Arani Bose. And the company was founded in 2004. Bose has recently stepped down. He was the chief innovation officer. He's now gone off to enjoy his retirement, whilst Elsisser is still there as the president and CEO. From what we've looked at all the companies we've seen over the years, founders tend to make great leaders in the sense that they often are more dedicated, they're more passionate, they tend to take a lower salary, and they often hold quite a lot of skin in the game. They own a lot of shares. In the case of Elsisser, I think he owns around 2.5% of shares, which doesn't seem like a lot but if you calculate, it's about $130 million worth, which is quite a lot. I mean, that aligns the interest of shareholders and management quite nicely. Okay. In terms of judging his performance, trying to figure out whether or not you have a good manager on your hand is quite difficult, especially if they've only been there for a short time. In the case of Penumbra, he's obviously been there for nearly 2 decades now.
It's something that actually I would ask, if people are really interested in learning more, give us a comment below and say, we want a management ebook or something, or guide on what you look for in good management teams. And I'm sure that's something we could offer in the future.
It's certainly an interesting topic to explore. When it comes to, a lot of people like looking at the share price to judge the quality of a management team. In reality, it's often a poor indicator, especially if there's a new CEO that's only been there for a couple of years. A lot of the time, these individuals, they're great businessmen, but they know how to bolster their share price. They'll maximize their options, and then after 4 years, they'll go somewhere else.
When I was a hedge fund, when I was in the hedge fund industry and an analyst on the equity side, one of the things we always knew, which is the concept of kitchen sinking. So when a new management or CEO comes in, they always, the first quarter that they always make it the worst, because then you start with such a low base. So the sun shines great on the other side. And that's why, so when we were trading it or we were looking to buy it or short them, especially in the short cases, that they're probably going to be worse than expected, especially in that transition of a new management, because they want the optics to look so bad that it can only look better for them. Like you say, they're great.
Yeah, and they often disguise it as well, saying this is as a result of the problems or mistakes made by the previous manager. Then he's now there to fix it.
Which is why I think we look at history a lot. So we say, well, one, if the company is founded by an individual who still runs it, that's always a positive, because he tends to be mission focused, and his objectives sometimes are beyond just trying to maximize his own wealth and shareholder value, right? Because he could easily have exited much earlier. He's trying to create a business which is sustainable and long term. And if it's management who've come in, it's what's their history, where else have they worked, and how long have they worked at those places, and what they achieved in those places to make sense. And actually, strategically, are they the right person? I think we looked at, remember, Curry's, and the individual had come from, his previous background was in making businesses go digital. So you're like, okay, that makes sense, and he's the right hire. But then you look at other businesses and you say, oh, that makes sense, because he was probably the wrong hire. Like I think HP had that issue, and I remember I think one point they wanted to get rid of all their laptops, and it was just very.
There's strange decision making a while ago at that company.
Yeah, and that happens because you get people who don't tend to have the right experience for where you want to go, and they might focus on the wrong things. But yeah, it goes it's an interesting thing, something that people can learn more about, and some of the other companies we look at on the moneycog.com as well. So I guess talking a lot about, we talk about management now, we haven't really talked much about another aspect that we look at, and which I don't think any other provider provides, which is competitive advantages of companies and threats. They talk about it a lot, but you can't find that information, and that's something that we do a lot of work to do and find, and we've got our own unique tool, don't we? We have not a tool, but we have different a framework which we say is a competitive advantage. So I don't know if it's worth sharing the note at this time on what we think, what we say are good competitive advantages and what aren't.
If I open this part of the report and then people can see. Okay. So in the case of Penumbra, when it comes to breaking down where the competitive advantages lie, a lot of it sort of stems from pricing power and cost and capital efficiency. Usually when it comes to the medical industry, there's a very high barrier to entry, just because it's a highly regulated space and has, as a result, ends up being very capital intensive. In the case of Penumbra, this does protect it from disruptive young newcomers into the space, but in reality, it's not really that advantageous, because it already has such fierce competition from companies like Johnson & Johnson and Abbott Laboratories. Where the firm seems to shine, however, is as a result of its patent portfolio. So I think at the moment it has around 85 patents under its belt, something like that. Oh, wow. And there are a few expiring the next few years, but the bulk of its product portfolio, who are protected by their main patents, that doesn't expire till around 2029. So they've got a good just under a decade to maximize as much as they can from those before having to replace with a new revenue stream or create new products with new patents that then can replace their existing ones. And that's often easier said than done, but they've got a lot of time to work it out. What management is potentially, well, not management, where Penumbra potentially has the advantages when it comes to immersive healthcare, assuming that ends up being everything people expect it to be, there's potentially a multi-billion-dollar market opportunity there. And as it stands, Penumbra appears to be the largest player in the space. They have a size advantage, and they've now got their first product on the market. We'll have to wait for the next set of results to see exactly how that product is performing, whether it's meeting expectations. But there's a lot of anticipation building up around whether or not it can dominate within the immersive healthcare space. And if it does, then the expiring patents may not actually be that much of an issue in the long term, because it's got a whole new set of patents which protect it from this new avenue they're entering. So I think that definitely helps it stand out from the crowd. Overall, the moat, I think it's got a fairly wide moat, but whether or not it's big enough, time will tell. I think there's a lot of dependency being placed onto this immersive healthcare, a big bet being made by management. And if it pays off, brilliant. If it doesn't, then there could be some issues later down the line.
Interesting. Quite a few, I guess, strong competitive advantages there. And what about the threats that you feel?
So when it comes to the issues, well, we sort of tapped up to it already. It's I think one of the biggest things is the immersive healthcare. There's a lot of anticipation building up around it. My main concern, not necessarily is the space, because I think there's a lot of promise when it comes to using virtual reality to deal with psychological ailments. Is mainly to do with the fact that Penumbra has no experience operating in this space. For the last 20 odd years, it has been first and foremost a cardiovascular company, a firm specializing in dealing with circulatory issues. So how do you go from that into virtual reality? And it seems like a big leap, but we'll see if they can pull it off. Brilliant. If not, there could be some issues, which sort of makes it like a bit of a coin flip to some extent. We'll soon find out. But in terms of the core business, which is the cardiovascular and neurovascular products, I think the biggest threat to that is the need to maintain the relationships with those medical professionals. In the end, those are their customers. And if product quality were to deter, or a competitor is able to come along with a cheaper, more effective solution, then that revenue stream could become compromised very quickly. In fact, if it is as a result of product defects and ends up doing more harm than good, then likelihood is they could permanently sever that relationship, and that is a problem.
Nah, makes sense. And I guess we're taking all the competitive advantage, threats, management. We've discussed quite a few things. I guess the key thing for anyone and for any investor is valuation, because you can have a great business, but at the wrong price, you don't really want to own it.
I think a lot of people who bought towards the end of 2021 are probably feeling that pain right now.
Yeah.
The share price has come down quite considerably. When it comes to whenever we do the valuations in these reports, we often take a discounted cash flow approach. Multiples sometimes are appropriate. In this case, we opted for the former. And when it comes to forecasting the vascular side of the company, it's relatively straightforward, to be honest. The demand for growth of cardiovascular and neurovascular products has pretty much stayed consistent over the last couple of decades. And people have blood clots. It's unfortunate, but we have the tools to fix them, which is positive. When it comes to immersive healthcare, this is where things get a bit more tricky. Like we've repeated several times now, we just don't know. There's a big question mark surrounding that. There was an investigation published by a research group called Fortune Business Insights, and they predicted that the immersive healthcare space could be worth up to, I think, $6.2 billion by 2029. And versus today, that's, I think, roughly around a 38% annualized compounded growth rate, which is extraordinary. I mean, that's huge. And obviously that presents a lot of opportunity. But this is where the valuation gets a bit lopsided to some extent. Even today, after it's fallen so much, these shares still trade at a very high premium because there's so much anticipation being built into this immersive healthcare technology. If we look, just to put it in perspective, if people can look at the report to get the full breakdown of the model, but from a forward price earnings growth ratio, the PEG ratio, it currently trades at around 240 times, which is a lot.
Yeah.
So if its real immersive system works and it ends up being a hit, that valuation could quickly justify itself. If it flops, the share price could have a long way to go down.
Oh wow! So a lot of so again, there's a lot being cooked into a future opportunity. Sounds interesting. I guess we don't want to reveal the COG score. So the COG score, people who are really interested can go on the moneycog.com website and sign up for premium to get access to our unique COG score frameworks, in which we value companies between 0 to 100, and we look at qualitative and quantitative metrics as well to come up with a score out of 100 of strong, great businesses. And we've done that, and we found that the COG scores had great success in the last few years in predicting good businesses and good valuations. So it takes into account everything that we just discussed on this video. But if you want to learn more about what the Money Cog is and how we look at things and companies, we've got this great website where we've been writing a lot of blogs and a lot of educational content as well, that you can go and do your more research beyond just watching this video. So for those that are interested, they can go on the website. Thank you, Zaven, again for doing another round of this company analysis. And we look forward to some future content where we're going to be doing different things. Those who are watching, we're going to be doing content which is more focused around education and market related things as well. So stay tuned.
Sounds good.